Thank you, everyone, for joining us today. I want to welcome everyone to our webinar. Today, we will hear from J.C. Hobbs. He is our OSU Extension Farm Tax Specialist, and he will discuss taxes during drought and other natural disasters. If you have questions, please ask them in the chat window. You may open the chat window by clicking the chat button at the bottom of the screen. If you have questions, JC will answer them at the end of the webinar, and more farm financial management resources may be found on the eFarm Management page. I will share this link in the chat window. JC, I will turn it over to you now.
Thanks, Brent. As Brent said, we're going to cover two parts of this thing. So I've broken it into two separate pieces. The first one we'll talk about is weather-related sales of livestock, which has been a major concern of 2022. We've had a lot of drought issues and a lot of farmers, ranchers that have sold livestock due to the drought, lack of forage, lack of water, etc. So what does the rules apply to? Sales of livestock due to weather-related conditions, that can be flood, drought, anything else that's causing any shortage of water or feed. What it does is postpones recognition of income on the tax return from the sales proceeds to avoid bunching of income in the year of sale, when normally we would not have that large of a sale or income, because those animals would not have been sold all in the current year because of a drought situation. So we're just avoiding bunching of income to kind of get an idea of what how things can work to give us some tax relief. Now, drought information, disaster information, a lot of this presentation requires that certain events or declarations occur. And here's where disaster declarations for drought, etc., can come from. We've got FEMA, Farm Service Agency, and typically Farm Service Agency has a lot of the ag declarations for crop programs, livestock programs, also the drought monitor. And then when we get to towards the end of the crop year, IRS typically or will put out a notice. They do this annually, that often allows us to extend the replacement period for livestock sold due to a drought condition. So that occurs typically every September. Sometimes it gets pushed into early October, but that information then gives us some more room to work with. We'll explain that in a moment. So if you look at the Secretary of Ag declarations, look at the orange or the red, however it comes up on your screen, you can see that all of Oklahoma and much of the western half of the U.S. has received drought declarations from the Secretary of Ag. What this does is it gives us ability to have a little more benefit of the tax treatments. So both tax treatments, the rules that apply to sales in excess of normal, that being in excess of normal business practice, and it's due to the weather-related conditions. The first one applies to the sale of any livestock. That's 451G. We can defer the income under this provision for 1 year for those sales in excess of normal. So you're moving income that would normally be reported in 23, that would, due to the fact of the drought, we had to sell animals in 2022. We can now elect to use this, move that extra income into 2023 so that we don't have to tax it in the current year. The second one applies to sales of animals, livestock, other than poultry, with the stipulation it has to be held for draft, breeding, or dairy purposes. This is code section 1033E. The reason these are on here and highlighted, these are references that you can take to your tax preparer, tax advisor. They can look up the rules and kind of get an idea of what's going on. Now, as we get into this presentation at the end, I've got some other references so that you can actually print those and look at the rules that do apply, and plus examples and other information. So in order to get the 1 year deferral, that's the 451G rules, the drought, flood, or other condition has to be of such severity that the area is declared eligible for federal disaster assistance. Has to have a federal disaster declaration. if you look at that, that's well, we have the Secretary of Ag information that got us there. So with the Secretary of Ag declaration, we have the ability to defer this income for 1 year on sales excess of normal. All we have to show is a weather-related condition caused the sale of more animals than normal. That's just essentially those maps. And the farmer must use the cash method of accounting. That's the norm for most of our farmers in Oklahoma, as well as the nation. Most of them use the cash method of accounting. So it applies to any livestock. So remember, we talked about earlier that one of them only applied to draft, dairy, and breeding. Well, this applies to any livestock, draft, dairy, breeding animals, market animals, poultry, etc., that are sold in excess of normal due to a weather-related condition. Now, the sale proceeds, that's the income from those animals sold in excess, can be deferred to the next taxable year, but we have certain requirements that we have to meet. That being our tax preparer or taxpayer, farmer has to be primarily in the business of farming. So the majority of our income has to come from the farm operation, that being taxable income. Must use the cash method of accounting, have to show that the animals would have normally been sold in the following year. So we go back, look at the 3 prior years, look at our average annual sales. We then compare that to the sales amount that we had in 2022 due to the drought. The amount above, the number of head above the average of the 3 years qualifies for this excess of normal deferral provision. And again, conditions have to cause the area to be declared federal disaster area declarations. Now, the sale can take place before or after the area is declared eligible, because essentially sometimes we'll have a drought starting and we see that we're going to lose pasture. We can sell those animals, but once we do, the issue becomes then we need a disaster declaration that allows us then to postpone that. And again, taxpayer history gives us that what is normal versus what was in excess. Now, sale proceeds from those animals, it's deferred. Essentially, we make an election on the tax return, file the appropriate information. That amount then gets reported as income next year, so in the year following the sale. Now, the second one, it's the involuntary conversion. Now, I didn't put any examples in here, and I failed to mention earlier that I've sent Brent the full version of this presentation that has examples and lots of examples, lots of additional information that can be used to your benefit when you talk to your tax preparer. So you may want to make a request, have Brent send you that, or it's going to be made available so that you'll have it. Essentially, again, this is kind of pared down to fit in the time span that is allotted. So the 1033E rules, that's one that only applies to draft, dairy, and breeding animals. And we have under those rules the ability to elect to postpone recognition of that income simply by making the election to repurchase those animals within 2 years after the drought ends. So due to the drought this year, if we sold breeding animals in excess of normal, we can defer that income by simply making the election that we're going to replace those animals, the value of those animals, by the end of 2025. Again, it doesn't apply to poultry or market animals of any kind. So stockers doesn't apply, calves doesn't apply. But the replacement period can be extended from 2 to 4 years. And the reason that I put that IRS notice up, that is what gave us the ability now to postpone replacement from 2 years. So if the drought ended next year, we'd have 2025 normally, but now we'll have until 2027 to replace those animals. So we've received the declaration. More information here. They can be held for any length of time. So even though the animal may not have been 2 years old, so we have replacement heifers. that we have on the farm that we decided we're going to hold those and we're going to put them in the breeding herd. But due to the drought, we can't do that. We simply sell those animals. They were intended for draft or intended to go into the breeding herd. Well, those do qualify for this treatment. So the gain that comes from those animals postponed. All we have to do is purchase replacement animals. Get my tongue tangled. Purchase replacement livestock within that time period. So right now it's 4 years for Oklahoma. The replacement animals must be used for the same purpose as those that were sold. So if we're in a dairy operation and we sell dairy cows, we have to buy dairy animals back. If it's beef breeding, we buy beef animals back. So they have to be used for the same purpose. Now, the rules state for this to apply, we have to have extreme, exceptional, or severe drought conditions that persist in that area. And again, it comes back to that IRS notice. It can also be other information. The Secretary of Ag declarations can also be used. All we have to do is be able to show that the applicable region has been affected, and that region is the county that you operate in or have cattle in that experienced a drought condition, and then all contiguous counties to that particular county. So it can be our county or the one connected to it. That becomes the applicable region that we can apply the 1033E rules to. So it gives us quite a bit of latitude. So the 2-year replacement period, that exists if the drought area does not receive a federal disaster declaration. It goes to 4 years if it does. And if the drought continues for 3 or more years, so the drought persists for more than 3 years, then we can extend that even further. I've noticed some counties in Oklahoma that we've had a 6-year period of extensions to before we have to buy those animals back. So if the drought ends next year, those folks that have been extended for those 6 years will have to start buying animals back. Now, again, no requirement that the weather conditions cause the area to be declared federal disaster area, but it does help. It gives us that longer time to buy those animals back. There's involuntary conversion rules that do apply here. Your tax preparer will understand what that means, but basically it's a situation that caused you to be forced to sell the animals before the time period that was really ideal. So it's an involuntary conversion. You didn't want to do it, but due to the weather conditions, it caused that sale of those animals that were in excess of normal numbers. So to make the election, there are some rules that we've got to follow. And the elections talked about in that material that we'll point you to in a moment. We have to show evidence of the weather-related condition. Again, the drought maps, the IRS notice, etc. We have to compute the amount of gain that comes from all the animals sold, the number of kind of those animals that were sold, and how what caused them to be sold in excess of normal, and normally what would we have sold. That goes back to that prior 3 years of history. That gives us our usual or normal business practice. So we've got to look at total number sold, then the number of sold in excess of normal compared to what would normally have been sold. So again, replacing the cows, we've got 2 years to purchase a replacement. Since we've got the notice, we've got 4 years now to do that. So if the drought ends in 2022, we have until 2027 to buy the animals back. Now, the replacement of those animals, it doesn't have to occur all in 1 year. It can, but it doesn't have to. All you have to do is buy back as many dollars worth of animals as were sold. So in order to make this thing work where you can postpone all the gain, you simply have to buy back the same dollar amount. So let's say we sold $30,000 of cows in excess of normal. In the next 4 years, we have to buy back $30,000 worth. Doesn't matter if that was 10 head, 20 head, or 30 head. Number of head doesn't matter. All we're worrying about is taking care of the amount of dollars. So we buy back the same number of dollars that were sold. That becomes the tax basis of those new animals. So if those cows are raised cows and we sold them, they brought 30,000, we buy back $30,000. The basis in our new animals is essentially the same as what we had when we sold those cows. So they're going to withhold that. And again, your tax preparer will understand what that truly means. But it helps from the standpoint of the tax treatment later when those replacements are sold, because essentially we defer the income that's reported on the tax return from now, the year that they're sold, until we sell those replacements. So we're kicking this can down the road probably anywhere from 6 to 10 years, depending upon how it all plays out. So again, gives us a great deferment. So we replace those animals. Here's the information we need: the total cost of the replacement animals, total cost of those cows, the sale value then of the animals sold in excess of normal. We net those two, the tax basis of the cows sold in excess of normal. So you're going to look at the tax return for the year we sell them to see what the basis in those animals were, because that's what we're going to have in the basis and when we buy them back. And then the total number of replacement animals purchased as well. So this information gives us, these pieces of information gives us enough information when we file their tax return in the year we buy them back, as well as the year that we initially sell those animals at a later date. So which option between those two, the 51G, the 1 year election deferral versus to buy them back? The decision is not an easy one. Everybody's economic situation, tax situation, goals will be different. Something to look at, for one, is what things are in place in terms of your current tax situation. Do we have net operating losses that are being carried forward? Do we have capital gain losses that we can offset the income from? Do we have other events that we can use, tax or income averaging? Those things all need to be weighed out, evaluated to determine which one is best. Last bullet here says consult your tax advisor. This is important. Selection of the right tool can result in a significant amount of tax savings, tax management that can be applied to your operation. So consulting with your tax advisor is important, is crucial to make the correct decision of what to do and how to handle it. Some information or references. Ruletax.org. There's an article there if you'll notice about halfway down the page, it's highlighted. Brent's going to also make this available. If you go to that website, it will bring up an article that you can actually download and print that talks about everything that I've covered here, plus provide some examples for those two different tax treatments, how they can apply, what things you need to consider when you put it into the tax return. So your requirements for tax return information, making the election, records that need to be kept are all discussed in this article. Take a copy to your, again, tax advisor, consult with them, discuss it, see what opportunities you have, which rules can work out best for your particular tax and operation. The next piece that Brent asked me to talk about was some of the disaster losses. We had a lot of these this year. We've had a property loss due to flood. We've had property loss due to fires. So when you look at disaster losses, it's a casualty loss, basically defined as a sudden, unexpected, or unusual event, not a gradual deterioration. So it's a loss from theft, vehicle or equipment accident, a fire that's not willfully set. If you're burning your pasture and it gets away from you and burns machine shed down, that doesn't count. But a fire that you don't willfully set, it gets set by accident, a lightning, etc., that applies. It's flood, tornado, earthquake, you can see lightning, freezes, terrorist attacks, vandalism, etc. Government ordered demolition, government ordered relocation. That's what a casualty loss is. So when we start looking at Oklahoma and what our casualty loss causes have been, it's been the floods, it's been the tornadoes, The fires. Those are the big ones. We've had some other problems, but those are the big ones. Information on these, or where you can find what Oklahoma qualifies for. Again, you can go to the FEMA website, which we pointed out earlier. You can also find information on various events that occurred going back to the Secretary of Ag. They list floods, they list tornadoes, things like that. Anytime there's a disaster declaration there. So there's a variety of sources to get information, whether or not it qualifies or your area qualifies. So then we have to decide how much was the loss. So you're looking at the property condition immediately before the casualty occurred and immediately after. So how much damage was done? Was it a complete loss due to the fire completely destroying it? Or if it was a tornado, did it just take the roof off the building or damage the roof? So again, you're going to look at the value before, condition, before and after, to kind of get an idea of what that loss is, the amount of the loss. The type of property also has some different rules that apply. Business use property. That's anything used in the business operation. That's machinery, that's equipment, that's cattle, that's other livestock, whether it was purchased, depreciable versus non-depreciable, and if there's any cost sharing for replacing or rebuilding. So if it's business use property, and when we get into this cost share, if it was fences and those fences were lost due to floods, there's been several situations in the past where FSA has come in and they'll do a cost share for replacing, rebuilding those fences. And depending upon, again, how much was the basis of the fence, how much you spent, how much reimbursement you received, will dictate the tax treatment and whether it's taxable or non-taxable. Then we have personal use property. Personal use property would be the house on the farm. It would be the car that's not used for business purposes ever. So personal property use is much different than business property use. Also, we have to look if it was insured. So if the property was insured, we compare the insurance proceeds back to the value, the basis of the property. Depending upon what all happens, we could have a taxable gain that occurs, or we could have a loss that we get to offset other taxable income with. So when we get into these disaster areas or in disaster losses, there's a lot of different things we can look at or need to look at to get an idea of what all is taking place in the tax treatment. So the tax rules that do apply. If it's business use property, we have to look at each individual item that was damaged or destroyed. So if fire goes through and we had fences, or we had buildings that were lost or damaged, we're looking at the tax basis of those items. Fences may have been fully depreciated, so then it has a zero tax basis. If it's a building, and depending upon whether or not how long it's been in place in the service, we may have some remaining depreciable basis left. That is a positive tax basis that we look at. Also have to look at whether that property was insured. If it was, those insurance proceeds are compared then with the loss that was taking place. So those are the two things that primarily come into play. Then we make the calculations. Was it a casualty gain? Are we going to elect to replace the asset? If we replace the asset and we spend money to do so, we may offset that gain, all or a part thereof, with the basis of the new item that we replace it with. So we replace a building, replace a machine shed with another machine shed. We have to look at, was it insured? How much did it cost to replace it, rebuild it, etc. If it was not insured and it wasn't fully depreciated, we may have a casualty loss deduction. So that same machine shed that we had depreciable basis left, let's say it was $20,000, it was completely destroyed. Then we have, and we elect not to replace it, we'll have a casualty loss that does apply of $20,000. So it ends up with some complexities, but the rules are there to hopefully help us out. Now, personal use property, again, requires the same thing. We got to look at each item. insured versus not insured. Now, the Tax Cuts and Jobs Act that was brought into play basically started in January of 2018 and goes till December 31st of 2025. It greatly curtailed, also sometimes eliminated itemized deductions that an individual can take. Now, if the area received a federal disaster declaration, then that supersedes a lot of what's going on with the itemized deduction. If it is a federal disaster declaration, you can look at the FEMA website. If it has that ability, or it was declared as a federal disaster area, your losses then are going to be allowed the itemized deduction rules. You're going to have to look at then, it's going to be subject to some limits for each event, $100, and then that gets reduced by 10% of adjusted gross income. So you just have to look at the total amount. You're going to reduce then the amount of the deduction by $100 plus then an additional 10% of the adjusted gross income. So you're not going to get to take a total loss, but you're going to get to take better than nothing. So we hope that the area gets the disaster declaration so that we do have the ability to have some itemized deduction against that loss or with it. So here's some helpful information. If you're looking at reconstructing records, the IRS has publications that talk about disasters, and it's a disaster resource guide that walks you through how you can reconstruct various records, various information, what needs to happen, where we can find historical information. So if your home is destroyed, and that's where all your tax records were, we can find those. We can rebuild that. So this historical information that we can find, that publication they're listed, helps us know where to look. Also, another way of documenting losses. Hopefully we've taken photographs before the loss ever occurred. This doesn't always apply, but at least take photographs after the loss so that we know what the property was. Make sure you have inventories, tax records. Those will all help you document the loss. The tax records would have the depreciation information that would show what the asset was worth, what we paid for it, how much depreciable basis is left, so that we can compare that to the loss to decide whether or not we have a deductible loss. And also if we have insurance, then we may have, again, like I said, potential for a taxable gain. So references here, we have disaster losses. Go to that website, it's halfway down the page. It has all the information that we just discussed. And there's examples for different types of property or assets that we find on the farm and how those are treated, whether they're insured or not insured. So there's 12 examples in this thing that are pretty extensive that walk your tax preparer through all the calculations that would apply anytime we have a disaster loss we would be subject to. Also talks about in that discussion how to reconstruct your records. There's a list of IRS publications and resources in that document. So it's a very good document to have, look at, and it will provide you some good basic information. Then you can take that information, go talk to your tax advisor. And once one of these disasters occurs, it is always wise to go talk to your tax advisor just as soon after the casualty occurred as possible. They're going to be able to help you decide what information needs to be gathered, pictures that need to be taken, etc. So don't forget to talk to your tax advisor and do it quickly. My contact information, here it is. Best way to get a hold of me is use email, jc.hobbs@okstate.edu. You also have the ability to send it questions to Brent, and he can forward those to me. With that, Brent, I want to turn it back to you. Let's see what kinds of questions we have.
Thank you, JC. Currently, I do not, let me check and confirm, but I don't think I have any questions at this time.
I don't see any either.
So I did share links to the rural tax page.
Great.
As well as the publications you mentioned in the chat box. Also share a link to our webinar survey that we asked participants to fill out in. I will change the settings now, so people may unmute themselves to ask questions over
Okay.
microphone if they want, or they can type questions into the chat box. We do appreciate everyone filling out these surveys for us and help us know how we're doing. So that link is in the chat box, and you can open the chat box by clicking the chat button at the bottom of the screen, as I mentioned earlier.
Do I need to quit sharing my screen so we can open up and see more people?
You do not need to quit sharing your screen.
Okay.
I just have the chat box open. And then we do have another webinar scheduled on January 17th. Scott Clausen will present that day. And he's going to discuss beginning of the year financial planning for livestock enterprises. And it'll be at noon as well. So you have the option of asking questions through chat or by unmuting yourself. If you have any questions, feel free to ask them, and JC will gladly answer them for you.
JC, on excessive sales and kind of documenting that, I guess, if you will, prices go up from year to year. Is it based on number of head more than it is price, or what? Maybe expand on that for me.
It's simply based on dollars. So granted, if you look at a year that we have a drought occurring, selling those animals often occurs during depressed prices because everybody's unloading animals. And when we want to start buying them back, others are wanting to purchase animals as well. So we end up having to pay a little more in most scenarios. Again, it doesn't matter number of head. All we're trying to do is reinvest those dollars so that we can avoid those dollars being taxed. If we don't, let's say that we spend or we sold those animals this year for $50,000. Those are the excess animals, $50,000 worth. Now we get in a few years later, we start buying those animals back. We want to buy $50,000 worth to replace those, simply because we can match at 50,000, then we have no taxable issue that occurs. But that's a pipe dream. That never occurs. What you don't want to do is spend 48,000, because then you'll have to go back and amend the tax return for 2022. So ideally, you'd want to spend a little more than the 50. So if you bought $52,000 worth of cows, then you will have $2,000 worth of tax basis, depreciable basis, that we can take in depreciation in either the year that we buy them back or over the life of the cows that the livestock we purchased them back, the number of head. So that's the key ingredient. It's not the number of head, it's the value that we sold them for, and we just have to buy back that many dollars worth. Hopefully that answered the question.
So I still don't see any other questions. So speak now or forever hold your peace.
Or send them to Brent later, he'll answer them.
Or send them to me. Yes, my email is brent.ladd@okstate.edu. So I'll be glad to forward any questions for you. I think I'm going to go ahead and end the webinar. Like I said, we have our next webinar on January 17th at noon. So hopefully we'll see you then. Thank you everyone for joining us today. And thank you, JC.
Thanks, Brent, for inviting me. Thank you very much.
You're welcome.